Welcome to WorldatWork TV. I'm Allison Avalos, and I'm joined today by Carrie Hsu. And we're talking today about some market pricing questions that come up in a down economy or even in a recessionary period. Carrie, what happens with market pricing when the market isn't moving much? Do organizations still price their jobs on an annual basis?
Allison, I think most organizations continue to price their jobs even when the economy is relatively stagnant or even in a depressed economy. I think if we kind of step back for a second and think about why are we market pricing and why do we do it on a regular basis, we're really trying to find out what's going on in the market. Now, from a macro level, while jobs in general may not be going up much, or they may even be going down in market value somewhat, it's very important, and we as compensation professionals need to be able to tell both our leaders within the HR organization and leaders throughout the organization what is happening with the market. It gets a little iffy if we're trying to guess at that and say, well, I think the general market is not moving very much, so we elected not to market price this year. That leaves a big question mark, and it leaves a lot of assumptions, and when you start making assumptions, you can get into trouble.
Do survey providers publish the data less regularly when we go into these phases of slower growth? Is it harder to get your hands on data when you're a compensation professional?
No, it's not really harder to get data, and I would say for the most part, most survey providers will continue on their regular schedule even when the market's not doing much or even when it's going down. In fact, I would say that when the market is going down, like we saw in 2008 and 2009, we at WorldatWork, for example, received much more interest from our members and customers about what is the market doing, what are other companies doing in terms of, are they freezing wage increases, are they reducing salaries, what are they doing with their salary structures. So it might be a little counterintuitive, but when the market drops considerably, that's when organizations get really interested in what the market is doing. So generally speaking, most organizations, most survey companies continue to provide information on an annual basis, and companies continue to look at their salaries on a consistent basis.
I would say from a WorldatWork research perspective as well, while we don't publish salary surveys, which are the primary type of survey that folks are using when they're market pricing jobs, we have found that during times of slower growth or recession, or maybe even coming out of a recession, there's almost more interest in data because so many people are paying attention to what's happening. There's a lot more questions surrounding how the market's moving, what are companies doing with their pay practices. And so we found that there's almost a greater interest during those difficult times and a need for those who are planning for budgets and responsible for pay programs to have data in their back pockets. So when we think about the comp analyst role, or the folks who are typically tasked with participating in surveys and pulling together data and making proposals, does their job change when the economy looks different? Do some sort of check out of the process of looking at data? Is it more important to pay attention to the data? Is there a risk if they don't watch what's happening in the marketplace?
There's certainly a risk, and I'm sure that it's happened where a comp department or a comp analyst has kind of fell asleep at the wheel, certainly during periods of very modest growth or no growth at all. We can kind of get into this mode of, well, the market's moved 2% this year, it moved 2% last year, it moved 2% the year before that. And so, you know, you just kind of get on this trajectory based on what's happened in the past. The market is going to move 2%. And again, you can make that assumption, but that's what it is. It's an assumption, and it may be false. I suggest that the compensation departments continue to follow a consistent method, whether the market is moving very slowly or or whether it's moving fast. In fact, you should have a sort of minimum schedule. For example, we're going to review our jobs annually. And then when we have situations that you brought up where the market is either climbing very fast or the market is dropping very fast, then maybe we need to increase the frequency every 6 months or every 3 months.
Some of the organizations I've talked to during tough times seem to be thinking about things in the way that you're talking about and trying to employ a certain consistency in their practices. One of the things that's been interesting to me, though, is even if they have consistency in their market pricing practices, where they're going out, they're looking at survey data, they're trying to keep a pulse on what's happening in their job markets, they don't necessarily have to translate that into pay increases. But the benefit to them, especially if cash is tight, they're not in a position to pay out during tough times. The nice thing about continuing to pay attention to the data is that then they know exactly what they're dealing with as they come out of it or move back into a growth period. They know what opportunities they need to consider. They're more aware of what might be enticing or compelling for their employees and make it difficult for their employees to stay. So that as soon as they have an opportunity to kind of shift into recovery mode and benefit the employees who have stayed with them through a difficult time, is much better for all, I think. Would you agree?
Yeah, absolutely. I mean, you bring up some very good points, and one of those points really has to be, by staying on a consistent basis, you're never sort of caught unawares. Let's say, for example, that an organization decides, hey, the market's just moved by 2% per year. Why don't we just skip a year? Well, 18 months down the road, all of a sudden your attrition for programmers has gone up to 35%. Well, then you are in reaction mode. You're trying to fix a big mess that you have where your CIO is on your desk saying, people are leaving for other organizations for considerable increases. We've again been asleep at the wheel, and now we have a big problem to fix. Whereas if we continue to monitor the pay levels of our jobs, and of course we want to pay special attention to our critical and hot skills, if there are movements, then we can address those before they become problems.
So let's talk about some of the technical aspects of pricing jobs and just looking at data in general. Again, from the context of some WorldatWork research and probably specifically the salary budget survey, even when the number seems to be the same year over year, which is something we do run into, we feel like it's really important for organizations to, one, pay attention to the data, but also look for kind of what's underneath it. Get deep down into it. Look at your industry, look at your region, look at some of the other programs that may be going up or going down so that you have a complete picture of what's happening and you can keep your organization competing where your comp philosophy says you should compete. I would imagine the same is true when you're looking at salary surveys. There's more than just that one number, that median number or that mean number that you're thinking about. There's more when you look at sample sizes, the growth or shrinkage that might be happening in a market. So I anticipate that even when times are tough, just like with your overall movement in your structures that you're looking at and general pay increase budgets, the same is true for the individual jobs and the salaries that go with them.
Yes, that's absolutely true. The salary budget survey, for example, many people sort of open the front page and look at the number, what is that, 2.9% or 2.5% or whatever that happens to be, and they close the book and they run up to their CEO and say, well, the market's moving by 2.9%, so that's what we should do. And of course that it sounds like kind of a silly example, but it probably happens quite a bit out there, and it's probably not what you want to be doing. One number gives you an overall picture, an overall feel, but as you well know, Allison, when we do the reports, we break it down by industry, and so if it's 2.9% in average, we have seen in the past several years mining and gas has been considerably higher than that, and education in the public sector has been considerably lower than that. So you're absolutely right. We need to be looking at not only the averages, but we need to drill into our particular segment, to our industry. We need to be looking at the size of our organization, the kind of business that we're in, to make sure that the numbers that we're looking at are relative and relevant to our organization.
So while it's important for the compensation professional to be aware of the economy and the movement around them in terms of the marketplace, they never really get out of that job of having to perform the due diligence year in, year out, no matter what's happening in the economy. Thanks, Carrie. For World at Work TV, I'm Allison Avalos.